Okay, so I'm here today with Ian Martin, our Chief Investment Officer, just have a bit of a chat about the XTB portfolios. There's been some big performance numbers out. You might have seen 9.8% return for the concentrated high yield portfolio. So Ian, big numbers,
Yes.
figures we've seen so far.
Yeah.
What are your thoughts?
Look, we've been obviously very pleased with the performance of the portfolios. These are quite significant returns that we've seen in the concentrated high yield. But investors should be conscious that the concentrated high yield, we select the highest yielding XTBs we can, and they are often the longest dated XTBs.
Yep.
So we have 6 year to 8 year maturity in there.
Mm-hmm.
So those portfolios have benefited from the falling interest rate environment that we've been in.
Yep. So mostly capital growth then rather than income coming through?
Very, very much so.
Yep.
So that's obviously accelerated returns to the upfront because of the interest rate environment that we're in.
Okay, and how do we see that going forward the next 6 to 12 months?
Look, certainly the doves, the people who think interest rates are going down, are in control of the market. The market really only seems to be responding to bearish news about the economy, which is good for the bond market. But I think we should be cautious. I mean, over nearly 2 25 basis point cuts are priced in by the marketplace at present.
Yep.
And we actually are seeing 3-year government bonds trading at 144. So a rational investor must assume that the average of overnight rates for the next 3 years is going to be below 144 to make that attractive, and that's what the market is telling you.
Okay. And what about fixed versus floating at the moment? Where do you see that playing out?
Look, certainly yield to maturity is low.
Yep.
We can still produce with something like an AGL, 2021 maturity XTB of 2.5%.
Yep.
And look, there is value in that. There is value in that if the RBA does not go, and you hold that to maturity, you will still get that 2.5, and you've still got that liquidity option. You've still got the daily mark-to-market benefit, and you've got the ability to sell small parcels if you want to get out.
Okay.
And at the same time, but if you buy floating, we can probably generate, we like to refer to traded margin above BBSW. BBSW is 170, and if we say you get traded margin of 50, you can get maybe 210 to 220 on a monthly style product.
That's assuming you hold it to...
That's assuming you hold it. But if rates go down, then that will fall, and you wouldn't have locked those in.
Sure.
Now, so that may be attractive for some people.
Yep.
If rates go up, then they can liquidate that without the exposure to interest rates.
Okay. And the other portfolios haven't done quite as well as the concentrated high yield?
Well, I would say the average or the total return is not as high, but for what they're designed to do, they've actually done very well. Okay. The maturity ladder, for instance, has done over 3.8%, and that's, we have no longer XTBs than 5 years, and you get principal of 1 XTB each year being paid back, which is, I think, a fantastic product for people looking for cash flow and control interest rate exposure.
Okay, thanks very much.
Great, my pleasure.